I think the markets are very hopeful, and in fact, it's in the incentive. There's great incentives for Canada to do so, because without being part of that deal, they certainly are left out in the cold. So they have every economic incentive to do whatever they can to join in the deal, even though it's going to be challenging.
And JJ, we've seen the dollar come off against other major currencies amid this trade deal with Mexico, and I think the expectation that we could start to see more such deals moving forward. Have we seen a peak in the dollar for 2018?
Well, Morgan, it's hard to say we've seen a peak in the dollar when we know that we're going to raise rates in the short term in September, and there's a high probability we may do so again in December. But I think the good thing about this is that hopefully the dollar stays in an area for a while where it's not sort of a straight up. So even if we go up gradually, it won't be as bad. You know, it's interesting, all this tariff talk. In the last earnings season, we had a lot more CEOs who are afraid of a strong dollar, it seemed, than they were of the tariff talk. So again, that's going to be a fine balance for us as rates seem to go higher as the economy continues to improve. And we'll have to see what happens in December, because, as I said, it's pretty much a surety next month.
Anthony, we had Treasury Secretary Mnuchin on Squawk Box this morning, talked about the trade deal, but also talked about the yield curve, which we've seen narrowing between the 2 and the 10. And he said he's not concerned about it, that he doesn't think it's a predictor of economic growth, that it's a market condition, and that they actually think they're completely content with the fact that you have a flat yield curve, given that the U.S. is issuing long-term debt. What do you think?
Well, I think that the yield curve is something that you should not ignore. I realize that people look at it to tell you whether a recession is coming, but the track record of the yield curve is not perfect either. If you look historically, whenever the yield curve inverts, it could be as early as 9 months before the next recession, and as long as 33 months. People use the average number. But one of the things that I've done is to look at 2 indicators, not only the inversion of the yield curve, but also the index of leading economic indicators. When that drops 3 consecutive months, that means a recession. When you put both of them together, guess what? You get a 100% track record in terms of forecasting a recession, and it's 11 months into the future. And so far, the index of leading economic indicators doing very well. And you saw, in fact, today, the consumer confidence gangbusters because of a very tight labor market. So I'm not worried at this juncture.
And to that point, just to dig into that a little bit further, you've got the strong consumer confidence, you got strong retail numbers, strong consumer in general, it seems like, strong economic growth, strong labor market here in the U.S. Is there anything that is bothering you right now, or that you do see as a potential indicator looking forward?
Well, right now, we all worry about the trade situation and, of course, geopolitical risk. But those concerns have been sort of melting away or thawing away, and that's the reason why the market is doing very well. And guess what? When you look at investor sentiment, it hasn't been overly bullish in this bull market. So these investors have been climbing this wall of worry, and that is good. That gives the bull market more longevity.
Home prices, Case-Shiller out today.
Yes.
Smallest gains in a couple of years. Function of rates, or is it something else? Just
well,
supply?
Remember that supply is an issue, and affordability is getting a little challenging. But at 6.4% year over year for that 20-city index, it's still rising more than twice as fast as wages are. So it is a concern for some people. Home prices are not out of reach, but they're certainly not becoming cheaper and cheaper as time goes on.